Trading psychology. Reasons why 95% traders fail. Most people think that once they learn technical analysis or chart reading, they can earn a lot of money. But it's totally wrong. The first thing that you need to learn is the mindset of a trader. Psychology is the most important aspect of trading. It teaches you how can you reduce your loss and increase your profits. Because no matter what strategy you follow, you cannot make a profit in all the trades. And it is the biggest mistake for traders that they don't want to accept the loss in any trade. So in order to make a consistent profit, you need these three things in your trading. Trading strategy, risk to reward ratio, and emotional control. These three things are like a tripod in your trading. You will not be profitable if you are missing even a single element. You strictly need all three. Importance of strategy. Why do you need a strategy? If all you need is a good enough strategy, then why are people losing money when you can find thousands of strategies on YouTube for free? That is because your small money does not make any difference in the market. Okay, let me explain. At any given time, small traders make up 95% of total trades, and 1 to 2% of total identities have enough money to move the market. Let's call them big boys. They can be a big trading firm, an investment bank, a hedge fund, etc. Talking about a small traders, these are normal people trying to make money from trading. So what exactly is the problem here? The problem is that the big boys know exactly what you are thinking and what you know about trading. Because most of the content that you are watching on YouTube or any other site is exactly the same. They know that if there is a big uptrend, all small traders will try to buy the dip to sell it higher and they use it to make bigger profits. And the money they make comes from other traders, mostly small traders. And it happens again and again. Small traders lose their money and all of it goes into the deep pockets of the big boys. So what did you do wrong? You did exactly what you were told, right? Well, you did nothing wrong. It's just that the competition is too smart. You have to know that just buying in an uptrend is not enough because the big boys have enough money to make or break the trend. So does that mean small traders can't make money? No, it's not the case. Small traders can make money if they learn to move with the big boys, which means you have to get in the trend when they start it and get out of it before they end it. And that is why you need a strategy that differentiates you from others. I learned this concept from a book called Trade the Trader. It's the number one book that I recommend to all traders. It says that you are not trading against price, volumes, or indicators. You are trading against other traders. If you can learn how other traders are thinking, then you can be ahead of them. Traders always try to guess the future price. Instead, we should try to guess the emotions of different types of traders because that's what is going to change the price. You might be thinking, how can we do that? So don't worry, we are going to learn this in detail in the next part of this course. So let's talk about risk to reward. Why do we need this? Why can't we go straight and book the profit directly? To put it simply, your risk to reward ratio allows you to win more and lose less by having the mathematical edge, thus making you a consistent profit. To understand how it does that, we must first understand the basic concept of the risk to reward ratio. Let's say that your risk to reward ratio is 1:4. That will simply mean that when I'm trading with an account of 100k, I'll only risk losing 1k to make a profit of 4k. That means you'll be profitable even if you lose 6 trades out of 10. If you're thinking how much risk to reward ratio you should keep, well, to save our time, I'm showing you the exact picture that I've drawn in my trading book when I started learning all this. As we can see in this picture, we have to win 60% trades to make a profit if we keep a risk to reward 1:1, which is a quite difficult task for a new trader. That is why it's not recommended at all. Because even if you win 50% of the trades, you will still be losing money because of the trading fee and transaction charges. So let's start with 1:2. As you can see, you have to win 40% trades to make a significant profit. That means you have to win 4 trades in every 10 trades. For example, let's say you are risking $1 to make $2 in every trade. You place 10 trades and you lost 6 of them. You lost $6 in those 6 losing trades. And you won 4 trades, that means you made $8. So in total, you made $2 profit in these 10 trades. Coming back to the same picture, if you choose higher risk to reward ratio, then you'll have to win less trades to make a significant profit. If you choose 1:3, then you only have to win 30% of the trades. That means you have to win only 3 trades in every 10 trades. If you keep it 1:4, then you only have to win 25% of the trades. And if you keep your risk to reward even higher, like 1:5, then you only have to win 20% of the trades. The risk to reward concept tells us that we don't have to win all the trades to make good profit. We can be wrong many times and still make good profit. So using this concept is a must in trading. The best ratio that I found was 1:4, and I'm trading this risk to reward ratio till now. So what can be the maximum risk that you can take in a trade? To answer this question, I strongly recommend that you never risk more than 1% of your portfolio in any trade. You'll get more chances to make money if you keep your risk lower. Also, your emotions will interfere lesser and it will help you stick to your strategy. As a trader, you must know the fact that one trade should never be able to make or break your account. Let others travel this dangerous path while you simply grind out consistent gains in a boring manner. So now let's talk about emotions. Only robot wins. As you dig deeper in trading education, you'll find a lot of articles and speeches that say only robots can win in trading. And it's not because they are faster or smarter, it's because robots don't get emotional. So it doesn't mean that you cannot win because you are a human, it means that you have to be emotionless towards your money while you are trading. People always end up losing more than what they make, and it's because they get emotional and stop using their trading strategies. As we saw, you need to use the risk to reward ratio in order to get a mathematical edge. Most people don't follow it. Even if they start using it, they stop when they have to accept a loss or when they try to make money faster. Let's discuss a few mistakes that I made when I started trading, and maybe you have seen it too. So the first one is, let's suppose there is a trend going on in up direction and you feel like it's about to change, but trend keeps going in same direction and your trade goes in lows. And it's not the only loss, because most people start a second trade in same direction to make a bigger profit. As the trend go up, they lose money, and still then they don't want to close the trades, because if they do, then the losing amount will be pretty big. And that's when they make the worst decision to wait for the trade to come back in profit. And you know what happens after that. In most cases, trader loses big numbers. The second one is, people move their stop loss when the price hits their stop loss. It happens because they don't want to close a trade in negative. New traders think that they have to make money in all the trades and they wait for the trade to make a profit. But what happens is, they start losing more money than they are making. It's a big mistake to change your decision after you start the trade. Market will always try to scare you, but you have to stay with the decision that you made before you started the trade. And now the third one is, don't blindly trust on any source that gives you trading signals or trading ideas. I'm not telling you that you should not follow any trading source. I'm telling you that you should always apply risk to reward with all your trades. You should not put all your money in a single spot, because there are many cases where market get manipulated and small traders lose their money. Now the fourth one is, most traders start using bigger lot sizes or they start risking more money in order to make bigger profits, but end up losing a lot of money because of that. It happens again and again because we don't get easily satisfied with small profits. Most traders want to get rich quick by risking more money, but in reality, it is the fastest way to lose all the invested money. Bringing us to number 5th, fear of losing out. People don't want to lose money. They cut winning trade early because they want to end this trade in positive, and they let it run when the trade gets negative. They try to wait for more than they should. This is the main reason why people lose more money than what they make. We call it fear of losing out. Most people lose money because they don't want to lose any money. That gets us to the last major mistake. Traders keep on starting more and more trades even when previous trades are running in losses. It happens when traders don't keep a stop loss in their trades. They end the winning trade in profit and they keep waiting for the other trades to get in profit. But what happens is, all those negative trades add up and become a big loss. Never keep more than 5 trades running at the same time, especially when you are a new trader. So these were all the big mistakes that I made when I started day trading. And I think you can learn from my mistakes and prevent big losses. So what can you learn from this? We'll keep these few things in mind. Always put a stop loss in every trade. Never double down on losing trade. Always keep your profit bigger than you lose using risk to reward ratio. Never risk more than 1% of your portfolio in any given trade. Never hope to make a profit in a losing trade. Accept the loss and close the trade if your stop loss is it. So next time, don't let these feelings interfere with your trading and try to trade like a robot, and strictly follow the risk to reward ratio in your trading. So the conclusion is, most people try to rush the process and try to make money as fast as possible. But this mentality don't work very well in long term. In order to make profit in long term, you need to master these three things: trading strategy, risk to reward ratio, and emotions. I'll suggest you should start with only $100 and work on mastering these three skills. Don't try to make a profit in your first 3 months. Keep your journey slow but consistent. Once you feel like you have a good strategy with perfect risk to reward and you can control your emotions while trading, then only you can invest the bigger amount in order to make a bigger profit.